I want to show you something that should deeply alarm every bullion bank on Wall Street. The figures you're about to hear are not opinions, guesses, or projections. They come directly from official Chicago Mercantile Exchange reports, confirmed delivery data, and publicly disclosed inventory numbers. Once you grasp what these figures truly imply, it becomes clear that the COMEX silver market is nearing a mathematical dead end. Today is Sunday, January 25th. L'Enseigning Archelot. Silver finished trading on Friday at $85, 73 per ounce, less than $1 below the recent all-time high of $86. 62 reached only days ago. But what happened in the first 2 weeks of January is far more significant. The COMEX delivered 45 million ounces of physical silver tied to expiring contracts. That single week accounted for 26% of the total officially reported registered inventory. That point deserves emphasis. In just 7 days, more than 1/4 of COMEX's deliverable silver was removed, and January isn't even halfway over. The March contract, the largest delivery month of the year, is only 6 weeks away. Current open interest for March represents 57 million ounces of silver, which is roughly 4 times the size of the registered inventory. This is where the arithmetic breaks down. The COMEX cannot realistically deliver hundreds of millions of ounces when only 127 million are reported as registered, and even that figure overstates reality. Analysts who closely monitor warrant transfers and vault movements estimate that the amount of silver that is truly free, unpledged, and available is closer to just 28 million ounces. The rest has already been committed, allocated, or effectively reserved. So the real comparison isn't 127 million versus demand. It's 28 million ounces available against 57 million ounces, potentially required in March. That's an 1/8-to-1 imbalance, 18 ounces of demand for every single ounce that can actually be delivered. This isn't merely a tight market. It's a scenario where failure becomes mathematically unavoidable. Now, let's look at the evidence. Let's examine what unfolds when an exchange reaches the point where delivery is no longer possible. And more importantly, let's discuss what actions matter over the next 6 weeks as this structure approaches its breaking point. Before moving on, a brief note for those who want more than surface-level analysis. I've created a concise educational resource that explains the internal warning signals that appear. Before we go any further into the figures, it's critical to understand what registered inventory actually means. The COMEX silver market divides its inventory into 2 categories, eligible and registered. Eligible silver refers to metal stored in COMEX-approved vaults that is not available for delivery against futures contracts. The silver exists, but the owner has chosen not to make it deliverable to the exchange. You can think of eligible silver like a car parked in a garage. It's real, but it's not being offered for sale. Registered silver, by contrast, has been explicitly marked as deliverable. The owner has informed the exchange that this metal can be used to settle expiring futures contracts. This is effectively the for sale inventory within the COMEX system. As of Friday, January 10th, the official CME warehouse report listed total COMEX silver inventory at 474 million ounces. That headline number sounds enormous, but only 127 million ounces of that total were classified as registered. The remaining 347 million ounces were eligible, meaning they were not available for delivery against futures contracts, immediately narrowing the pool that actually matters. That distinction sharpens the focus. The relevant number is not 474 million ounces, it's cent-vingt-sept million, that is, the pool of metal theoretically available to meet delivery demands. But even that figure requires closer scrutiny. Simply being labeled as registered does not guarantee that the silver is truly free to deliver, because many bars already have claims against them. Bullion banks may hold warrants on registered silver. Industrial users may have contracts tied to it. Technically, it is registered, but functionally, it is already spoken for. This is why analysts such as David Jensen differentiate between reported registered inventory and effective registered inventory, which refers only to silver that is unencumbered, idle, and genuinely available to meet new delivery demands, based on warrant movements, vault transfers, and delivery behavior. Effective registered inventory is estimated near 28 million ounces. This cannot be verified precisely because warrant ownership is not disclosed. In early January, Sancho-san, 45 million ounces were delivered. Yet registered inventory fell only 18 million. The difference came from silver already committed but still technically labeled registered until delivery occurred. The exchange is effectively running a shell game with its inventory reporting. Ounces that are already allocated are being counted as if they are freely available. This becomes critically important when we look ahead to March. If the true pool of available silver is closer to 28 million ounces rather than the headline figure of 127 million, then March delivery demand doesn't exceed supply by 4 times. It exceeds it by 18 times. That is the failure point. That is where the math collapses. Now let's examine the January delivery data, because this is where warning signals become impossible to ignore. The January 2026 silver contract is not considered a major delivery month. Historically, January delivery volumes are relatively light, with primary delivery months occurring in March, May, July, September, and December. January is usually quiet. Yet, in just the first week of January, the COMEX delivered 690 contracts. Each contract represents 5,000 ounces of silver, which means 45 million ounces were delivered between January 2nd and January 9th alone. This level of activity is highly unusual for a non-major delivery month and immediately stands out as an anomaly. To understand how extreme that is, consider this comparison. The entire month of December 2025 saw total deliveries of about 41 million ounces. In only 7 days, January delivered 81% of what December delivered over a full 31-day month. The delivery pace is accelerating sharply, and this is happening during a period that is normally characterized by low physical demand. So why is January suddenly so active? Because participants standing for delivery do not believe the silver will be available in March. They are choosing to take delivery now while they still can. This is front-running a shortage. Industrial users, well-capitalized investors, and bullion banks covering short exposure are all pulling metal forward into January. Now look at what happens to inventory when more than 33 million ounces are delivered. On December 31st, Downsilling Archewoo, registered silver inventory stood at 2 million ounces. By January 9th, it had fallen to 127, 1 million ounces, a decline of only 1 million. The missing silver came from metal already allocated, appearing available on paper but already claimed in reality. This is how the shell game actually operates. The exchange treats silver as available right up until the instant someone takes delivery. At that point, metal is reclassified or shifted from eligible to registered at the last possible moment to fulfill the obligation. On paper, this makes it appear that registered inventory hasn't declined very much, even though the real available supply has already vanished. In reality, the truly available supply dropped by the full 33 million ounces, not merely the 18 million reflected in the reports. This is precisely why analysts estimate that effective registered inventory, the silver that is genuinely available, is now closer to 28 million ounces. Once all allocated, claimed, and spoken for metal is excluded. The remaining pool is shockingly small. To see that this drain is real, we can look directly at the daily withdrawal data. On January 7th alone, COMEX vaults recorded withdrawals of 25 million ounces, marking the largest single-day withdrawal in more than a year. That metal did not disappear randomly. It moved to parties who demanded physical possession rather than paper exposure. Some of that silver was delivered to industrial users. Some went to private holders taking physical delivery. Importantly, a portion was acquired by arbitrage traders who shipped it to markets such as Shanghai and Dubai, where physical silver is commanding premiums of $8 to $15 above the paper price quoted on Western exchanges. We'll discuss the Shanghai premium shortly. But the immediate takeaway is clear. The vaults are bleeding, and that bleeding accelerated sharply in early January. Between January 2nd and January 10th, total withdrawals across all depositories exceeded 41 million ounces. That represents a net outflow of roughly 5 million ounces per day. If that pace were to persist, the registered category would be effectively exhausted by mid-February. Will that exact pace continue? Possibly not, because delivery demand can fluctuate. But the direction of the flow is unmistakable. Silver is moving out of the system, not into it, pushing the structure closer to a breaking point. Now let's turn to the March cliff, because this is the most critical piece. March 2026 is the next major silver delivery month. As of Friday, January 10th, open interest in the March contract stood at 487 contracts. Open interest represents contracts that remain open and have not yet been closed or settled. Each futures contract corresponds to 5,000 ounces of silver. Multiplying the open interest results in 435 million ounces of notional exposure. In a normal market, only about 5 to 10% of contracts result in delivery. Even at 5%, roughly 25 million ounces would be required, a level that assumes ample, truly available inventory. But this is no longer a normal market. We are dealing with a shortage. We are inside a squeeze. When market participants detect scarcity, they choose to stand for delivery. In January, a non-major delivery month, we saw 690 contracts demand physical settlement. If a quiet month like January produced that level of delivery, the implications for March are profound. March is one of the largest delivery months of the year. What if 10% of open interest stands for delivery? That would equal 148 contracts. Or halt treads, 74 million ounces. What if 15% stands? That jumps to 76. 11 million ounces. At 20%, delivery demand reaches 101. 48 million ounces. This is where the arithmetic fully collapses. Let's walk through the scenario analysis. Scenario 1 assumes normal market behavior. 5% of March open interest stands, creating demand for 37 million ounces. Effective registered inventory is roughly 28 million ounces. In this case, COMEX barely delivers. Inventory is drained. Obligations are met, and March passes. But then May arrives, carrying additional delivery pressure. May typically holds around 70,000 contracts of open interest. If 5% stands, that equals another 5 million ounces. But registered inventory has already been exhausted after March. At that point, the COMEX cannot deliver. The failure does not occur in March under Scenario 1. It occurs in May. When the next major delivery obligation arrives with no remaining buffer, Scenario 2 reflects a moderate squeeze. 10% of March open interest stands for delivery, requiring 74 million ounces. With only 28 million ounces of effective registered inventory, the COMEX faces a shortfall of 74 million ounces. Delivery becomes impossible. The exchange must either induce conversions from eligible inventory using premiums or declare force majeure and cash settle. Scenario 3 is a severe squeeze. 20% of March open interest stands, demanding 48 million ounces. Even using the full reported registered inventory of 127 million ounces, the margin is razor thin. Any February withdrawals cause failure. Using effective inventory, the shortfall exceeds 73 million ounces. This outcome is catastrophic. Force majeure becomes unavoidable. So where are we now? Based on January's near-record deliveries during a non-major month, the market is operating between Scenario 2 and Scenario 3. This is an active squeeze, and the COMEX is fully aware of it. Before moving to the Shanghai Premium, it's critical to understand why this matters. The exchange's ability to deliver metal underpins silver pricing. When that breaks, consequences are immediate and severe. Make sure you subscribe and enable notifications, because over the next 6 weeks, leading directly into the March delivery window, I'll be monitoring this situation in real time. Each week, I'll break down updated registered inventory, new delivery notices, and withdrawal trends. You'll see whether the market drifts towards Scenario 1, 2, or 3, and that insight can directly influence how you act. Now let's turn to the Shanghai Premium. Silver is currently priced at $85, 73 on COMEX in New York, representing the paper price formed through futures trading. In Shanghai, however, physical silver is trading far higher. Based on multiple sources, spot physical silver is changing hands between $93 and $100 per ounce, implying a premium of roughly $10. In Dubai, another major physical hub, premiums are similar, ranging from about $9.50 to $12 per ounce. So why is physical silver in Asia priced $10 to $15 above the paper price in New York? The answer is straightforward. There is a real physical shortage in the East, driven by intense industrial demand that requires actual metal, not futures contracts. Solar panel manufacturing, electric vehicle battery production, and electronics assembly all depend heavily on silver, and China sits at the center of these industries. While Shanghai has long traded at a premium, today's spread is extraordinary. Historically, premiums ranged from 50 cents to $2. A $10 premium represents a 5 to 10-fold expansion of the norm. This divergence signals a critical shift. The physical market has separated from the paper market. Paper pricing says silver is worth $85, while physical buyers are paying closer to $96. In the real economy, physical pricing ultimately sets the truth, because solar panels and electronics cannot be built with contracts. They require real silver delivered in hand. This is why the Shanghai Premium constrains COMEX pricing. If silver were pushed down to $80 on COMEX while Shanghai remained near $96, Arbitrage traders would see a $16 opportunity per ounce. That trade would rapidly drain vault inventories. As a result, the premium places a floor under paper prices. The exchange is boxed in. Allow prices to rise and short positions suffer. Force prices lower and physical metal disappears. It is a checkmate scenario. This dynamic is already visible in the data. The 25 million ounces withdrawn on January 7th included silver, destined for arbitrage shipments east, visible through withdrawal timing and depository behavior. On January 7th, JP Morgan's New York depository reported a withdrawal of 1 million ounces of silver. That metal moved east to Shanghai. JP Morgan Chase facilitates east-west arbitrage, buying silver on COMEX near $85 and selling near $96 in Asia. As long as that gap exists, the trade is nearly risk-free. And every ounce shipped east reduces silver available for March deliveries. Now, look at the margin hike, another clear sign of stress. On January 7th, the CME Group raised initial margin requirements for silver futures from $22.000 to $22 sing cents per contract, a 47% increase. For traders holding multiple contracts, this required wiring large sums of cash immediately or facing forced liquidation by brokers. Officially, the explanation is risk management. Volatility is rising, so margins must rise. But the timing tells a different story. Silver traded near $72 on December 20th with margins at $22. Ling, ling, ling. By December 30th, it reached $81. On January, second margins rose to $28. Ling, ling, ling. After silver hit $85, margins jumped again the very next day. This pattern is not accidental. Margins are being used as a brake. Higher margins make long positions more expensive, forcing leveraged traders to sell and creating short-term pullbacks. After the January 7th hike, silver dropped intraday from about $85, 70 to 83 dollari, harsher, but quickly recovered. The hike added volatility without stopping the upward trend. What the margin hike really reveals is concern over clearing member risk. Clearing members guarantee trades and absorb losses if traders default. When the exchange sees rising exposure among clearing members, it raises margins to pull more cash into the system and reduce the risk of cascading failures during sharp price moves. The largest short exposure in silver is held by bullion banks such as HSBC, Citigroup, and JP Morgan. These banks are structurally short as part of their market-making roles. As silver prices rise, losses grow. A 47% margin increase in a single move is not routine. It signals that the short side of the silver market is under serious and escalating stress. The pressure has become intense enough that the exchange felt it had to step in. If a single 47% margin increase wasn't enough to cool the rally, another hike could follow. Margins could be pushed to $45, null, or even $50, $0 per contract. If silver breaks above $90, shutting out retail traders, thinning liquidity, and increasing the risk of sudden, violent price moves. When markets become thin, instability turns into real danger. Now, let's discuss what happens if the COMEX cannot deliver. This is not theoretical. There is a formal mechanism for this situation called force majeure, a legal provision allowing contractual obligations to be suspended when extraordinary circumstances make performance impossible, including the inability to source the underlying commodity. If physical delivery demand exceeds available registered inventory and additional silver cannot be secured, the COMEX can invoke force majeure. In practical terms, this means the exchange declares it cannot deliver physical silver and instead settles contracts in cash. The obligation to deliver metal is replaced with a financial payout determined by the exchange. If you are long a March futures contract expecting 0.000 ounces of silver, force majeure means you receive cash instead of metal. Crucially, the settlement price does not have to match the prevailing market price. The exchange has broad discretion to decide what it considers a fair settlement, even if physical silver is trading much higher elsewhere. We have seen similar actions before. During the 2022 nickel crisis, the London Metal Exchange halted trading and retroactively canceled trades above $50, 0.000 per ton. Prices above that level were effectively erased. The COMEX could take a comparable approach, cash settling silver contracts at far lower prices than the physical market. For anyone holding silver futures expecting physical delivery, this is the worst-case outcome. The COMEX has not yet done this with silver, but it has happened in other markets. The mechanism exists, and the legal precedent is established. It is not an abstract risk. It is an available option. In 2001, NYMEX, now part of the CME group, faced force majeure in palladium after Russia halted exports. The exchange could not source enough metal and settled contracts in cash. Traders expecting physical palladium received money instead. The precedent is real, and the structure for such action is already in place. If the COMEX faces potential March demand near 100 million ounces while only about 28 million ounces are truly available, force majeure becomes realistic, not extreme. Many assume such a declaration would crush prices, but that outcome is not guaranteed. In fact, it could trigger the opposite reaction. If the COMEX announces that it cannot deliver silver, it is effectively admitting a shortage and publicly confirming that physical metal is scarce. Paper prices may briefly drop as futures traders liquidate positions, but physical prices would likely surge. Paper and physical markets would split, with futures trading lower while real-world prices for physical silver rise sharply, strongly favoring holders of physical metal. Now let's walk through a potential timeline based on current data. This is scenario analysis, not a forecast. We are in mid-January, with effective registered inventory near 28 million ounces. If another 20 to 30 million ounces are delivered before month end, which current behavior suggests is plausible, registered inventory could be nearly depleted by February 1st. At that point, the COMEX faces a serious problem. March is only 5 weeks away, and inventory must be rebuilt. The exchange would attempt to incentivize holders of eligible inventory to convert it to registered by offering premiums. Some may agree, but many holders, especially industrial users and bullion banks, have little incentive to participate when Asian markets pay far higher premiums. As a result, the COMEX might secure just enough conversions to enter March with perhaps 40 to 50 million ounces of registered inventory. Then March begins. First notice day arrives on February 26th, when longs declare delivery intent. If 10,000 contracts stand, that equals 50 million ounces of demand, matching reported inventory on paper. But deliveries do not occur in isolation. Withdrawals continue throughout March, the Shanghai premium remains, and arbitrage flows persist. Another 10 to 15 million ounces could exit vaults during the month. By mid-March, registered inventory could fall to roughly 30 million ounces, while a similar amount is still owed in deliveries. The exchange barely survives. March deliveries are completed, but registered inventory ends the month essentially empty. Then May arrives. May open interest sits near 70,000 contracts. If just 5,000 contracts stand for delivery, that requires 25 million ounces. With registered inventory near zero, physical delivery becomes impossible. At that point, force majeure is declared. May contracts are cash settled, and the market reacts violently. That is the sequence. March is the edge of the cliff. If the system survives March, May is where it fails. The structure holds temporarily, but the underlying shortage is no longer containable. When force majeure is announced, several reactions occur simultaneously. COMEX silver futures likely sell off sharply, perhaps 10% to 15%, as paper longs realize they will not receive metal and rush to exit positions. This initial paper price shock contrasts sharply with tightening physical markets elsewhere. First, the paper price drops, but at the same time, physical premiums explode. If you own a 1,000 ounce bar, and the exchange admits it cannot deliver silver, that bar becomes far more valuable. Dealers raise premiums sharply. American Silver Eagles could jump from 35% over spot to 50% or 60%, while 1,000 ounce bars could move from 5% to 15% or 20%. The paper spot price and the physical market separate completely. At the same time, the Shanghai premium widens further. If Shanghai traded at $96 while COMEX was $85, and COMEX drops to 65 dollars on force majeure news, Shanghai does not follow. Chinese buyers still need metal. The east-west spread expands from $10 to $20 per ounce. Next, lawsuits begin. Traders who stood for delivery and were cash-settled file legal action. Class action lawsuits alleging breach of contract follow and drag on for years. Regulatory scrutiny explodes. The CFTC, the SEC, and Congress open investigations asking how this happened and whether bullion banks were too lightly regulated, while the exchange's credibility as a delivery market collapses. By the time investigations conclude, the damage is done. Silver trades permanently in a two-tier system, paper silver and physical silver, with physical commanding a lasting premium. So how do you position for this? If you hold futures and plan to stand for delivery in March, understand the force majeure risk. If you want certainty, take delivery earlier, in February, and remove metal from the system. If you already own physical silver, hold it. Do not let paper market volatility shake you out. If force majeure is declared, physical silver becomes more valuable, not less. Premium surge. Physical metal is the safest place to be. If you are buying silver now, physical is preferable to futures, even though premiums feel high relative to spot prices. Eagles at 35% over spot may feel expensive, but if force majeure occurs, today's premiums will look cheap in hindsight. Paying 35% over at $85 is better than chasing metal at 60% over $100 later. Consider mining stocks as well. If silver moves to $100 or $120, quality low-cost producers generate enormous cash flow, while high-cost juniors carry more risk. Stay data-driven. Watch warehouse reports daily. Track delivery notices, and monitor the Shanghai premium. The data will signal whether the market is moving towards scenario 1, 2, or 3. Now let's conclude. Over 33 million ounces were delivered in early January, roughly 26% of reported registered inventory in 7 days. Effective registered inventory is likely near 28 million ounces. March open interest represents roughly 57 million ounces, 4 times reported registered supply and 18 times effective supply. If 10% of March contracts stand, the exchange is short. If 20% stand, the shortfall is catastrophic. The $8, $15 Shanghai premium proves physical silver already trades above paper. The 47% margin hike confirms stress on the short side. All signals point to the same conclusion. The exchange is approaching a breaking point where it may be unable to meet delivery obligations. If that happens, force majeure becomes likely, bringing cash settlement, paper-physical divergence, lawsuits, investigations, and a fundamental restructuring of the silver market. This is not speculation. It is arithmetic based on publicly reported data. We are not years away. We are weeks away. March is 6 weeks out. First notice day is February 26th. Just 44 days away. In 44 days, we will know whether the system can deliver. If it cannot, everything changes. Position accordingly. Secure physical metal now. Consider early delivery. And recognize that the window to buy at tolerable premiums is closing fast.